Hey everybody, welcome back to Investing with Wesley. Recently I've noticed a lot of different people are a little confused at the different kinds of rates out there, specifically things like the federal funds rate, the prime rate, the LIBOR rate, the SOFR rate. There's a bunch of different rates that people talk about, and not everyone knows what they are or what they're attached to. So in this video, I'm going to go into detail on exactly what one of those rates is and how it affects you. Today's video is all about the prime rate. Let's get into it. The prime rate is one of the largest benchmarks that's used when setting the amount of interest someone is going to pay whenever they want to borrow money from the bank. Now, just like with pretty much everything out there in the finance world, there is not one hard set rule when it comes to the prime rate. A perfect example of this is that every bank has its own prime rate, and that the prime rate you see when you Google what is the current prime rate, that is a daily calculated rate that the Wall Street Journal does. And what they do is they ask a lot of American banks what their prime rates are, and they average them all together to create the Wall Street Journal prime rate, which is the benchmark that everyone talks about. So what exactly is the prime rate? Well, the prime rate is the interest rate that banks charge their most credit-worthy customers. And they do this to measure something called default risk. And default risk is the amount of risk that the bank takes on whenever giving somebody a loan. So obviously, the more credit-worthy you are, the lesser risk the banks have to take, meaning the less interest they will charge you. But you have to remember that the prime rate is not a hard designated number for the lowest possible interest rate you're going to pay. The prime rate is very fluid across multiple different banks. And if your credit is worthy enough, and if you can get the banks to compete with each other, you could actually get interest rates below prime. Now, the prime rate each bank sets isn't just conjured up out of thin air. The prime rate is closely tied to the federal funds rate. And as the federal funds rate goes up, so will prime. And as federal funds rates goes down, so will prime. Now, the federal funds rate, if you don't already know, is the rate that banks lend to each other overnight with their excess reserves. So if Chase Bank has excess reserves and wants to lend it to Wells Fargo, who is short of reserves, then the federal funds rate is what Chase Bank will charge Wells Fargo to lend that money to them. Also, the federal funds rate is the interest rate that all the media talks about when they said, oh, the Fed's just lowered interest rates to zero. That is not necessarily the prime rate. If you've taken out a loan recently or just happen to pay attention and notice, you'll notice that most people are paying still 3 to 7% in interest, even though the federal funds rate is close to zero. And this is because people don't pay the federal funds rate. Banks pay the federal fund rate. What people pay is the prime rate, but the federal funds rate is only bank to bank. So even though the Fed's fund rate is 0% interest, you're probably not going to see 0% interest on personal loans or mortgages for a very long time. Now, exactly how the federal funds rate is tied to the prime rate, I've noticed historically there's a spread of about 3%. Meaning if the federal funds rate is 0%, then prime rate will be 3%. If the federal funds rate is 2%, then prime rate will be about 5%. But I've also noticed there is nothing within policy or anything real hard and concrete on paper that says that the spread between prime and federal funds rate has to be 3%. Meaning the federal funds rate could stay at 0, but the prime rate could go all the way up to 6%. Or the federal funds rate could go up to 3% and the prime rate could stay at 3%. There's really nothing that says it has to be a 3% spread, but if you look at the historical averages of both, you'll notice there is about a 3% buffer. But the more important question you're all probably wondering is, why should you even care? Why should you care what the federal funds rate is, what the prime rate is, or anything like that? How does it affect you? Well, as I mentioned before, the prime rate is the rate that banks charge their most credit-worthy customers. So this prime rate directly affects what kind of interest rates you're going to be paying on things like personal loans, home equity loans or lines of credit, your credit cards, auto loans. Everything that you do when borrowing money from a bank is connected to prime. So it's very important that you are up to speed on what exactly the prime rate is whenever you're thinking about taking on a loan. Basically, when you're thinking about borrowing money from a bank for whatever reason, you want to know the prime rate and a couple other rates like the LIBOR or the SOFR rate, because certain banks use the prime rate or the LIBOR or the SOFR rate when calculating what kind of interest they should charge their borrowers. So if you're going to go to Chase Bank as an example or any other bank and you want to buy a car so you need to take out an auto loan, the first thing you need to do is ask what benchmark they use when setting their interest rates. And if they say it's the prime rate, then you need to know what the current prime rate is and how it will affect your loan. If you have very good credit, maybe you can get close to prime. But if you have very bad credit and prime is 3%, then you know you're probably going to be paying about 6%. But if the prime was already 6%, then you know 9% isn't that extreme considering the prime is already 6%. So it's very important whenever you're thinking about financing anything with a bank that you know what the current prime rate is so you can get an expectation of what kind of interest rate you're going to be paying. And like I said, it is always beneficial on your half to get different banks to compete with each other because it is very possible to get better deals, maybe even below prime. And just in case you're curious, as of today, the prime rate right now is 3.25%, while the federal funds rate is 0.25%, which only proves my point that historically there is about a 3% spread. I hope this video has helped you understand what the prime rate is and how it affects you and why it's so important whenever you try and borrow money. I hope you got value from this video, and if you did, please remember to like and subscribe because it really helps the YouTube algorithm and helps this channel grow and help educate more people on the very important topic of finance. But until our next video, have a good one.